Hey there, welcome to a new video, and this time I would like to share with you my recent purchase. It's a Spanish utility called Enagas. It's trading currently around €18 and the dividend is almost 9%. Was this a smart buy? Is the dividend at risk? Or is the value trap? This is what I will discuss with you today in this video. But hey, if you don't know me yet, I'm European Dividend Growth Investor and I have a blog at europeandgi.com. I'm also the co-host of the Dividend Talk podcast and I will add both links into the description of this video. But before we get into it, if you want to see more of these videos in the future, then please subscribe to this channel and hit the notification bell. It will benefit the YouTube algorithm and you won't miss any future video. And besides that, I'm just trying to grow this channel, so any new subscription really motivates me. Thanks for that. And remember, I'm not a licensed professional, so please do your own homework, see this as inspiration, and yeah, let's get started. So let's look into Enagas then. So Enagas is a Spanish utility company. It's well known for its gas distribution network in the whole of Spain. It was founded in 1972 by the government to get better control over the whole gas distribution network. And it was privatized in 1994, if I may remember correctly. And since 2002, it is listed on the stock exchange. So since 2002, we can actually invest in this company. As you can see here in their annual report from 2019, they have quite a history of also of international acquisitions because it also exists currently in other countries. And I would say the most recent acquisition in Telgras Energy is one of the bigger one in their history at the moment. So how does it earn its money? So for that, again, a good example is their annual report because they have a really nice picture here. So what you can see here is what you need to know. Gas is nowadays being liquefied. So let's say that there would be an LNG plant in Saudi Arabia as an example. They would extract the gas, but you cannot just build a pipeline from Saudi Arabia to Spain. I mean, you can, but it's not really efficient. So there was a lot of innovation going on and they freeze now the energy into 160 minus Celsius, and this allows it to actually put it on a container ship and ship it, or a gas ship. But once it hits the shore in Spain, then Enagas really comes in because that's where they regasify it. So they make it again a gas that we consume as citizens in our homes when we are heating our heating system. And this is really where Enagas takes over. So this the whole gasification, the distribution, but not the last mile. The last mile is being done by local operators. So it really serves here as kind of also as a toll gate, and this is also how it earns its money. So it gets a certain price for the distribution of it. So where is Enagas present then? Because it's not a purely Spanish company. And as you can see here, their majority is in Spain, of course, because that's where they earn the majority of their money. But they have also stakes in companies in the USA, in Mexico, Peru, Chile. And all of this you will see later in the annual report if you would dive into it as income that is consolidated also based on other contributions they have. Because they might not have a majority stake, but they earn their money there in dividends that are being sent back to the company in Spain. But it's also having a stake in Greece, in Italy and Albania. So now that we know where the company is present, how their value chain looks like and how it earns its money, let's go a little bit further down into the report, because here you will also see its strategic priorities, which I think are quite important here. And I thought it was on page 20. Here we have it. So their growth areas, how they see them, are really the renewable gases in biomethane, hydrogen, and this is something that they really want to bet their cards on, and as a support to the renewable energy trend that's currently going on. But its core business, of course, is also development of gas and infrastructure. And if you look a little bit up in the report, you can also see that they are expecting the share in gas still to rise until 2030, because gas is so-called transition energy until really have had the innovation and know how to make renewable energy sustainably and that we can really also depend on it, and not when there's no wind that we don't have energy. Now here you can see the share of renewables is intended also really to grow from 13.5% to 31%. This is also where Enagas is really looking at to take a share of the market there. Yeah, and of course, it's probably also really, I said, good to mention that they are full doubling down on sustainability and they are really supporting the climate Paris Agreement. Although I would lie if I wouldn't, because I would also need to mention, of course, that the Spanish government is heavily pushing on this and also putting incentives on Enagas to make sure that they deliver on their sustainability goals. And this is probably also important to know because this company is heavily regulated. So this means that, as an example, that Enagas may not have any shareholder which has a stake of more than 5% in the company. So effectively, it's prevented from takeovers by the Spanish regulatories, and you really would need to strike a deal with the politicians to be able to take over Enagas. So it is quite a protection there, but maybe this is also one of the reasons why the stock price has a cap above it, because there's no, for instance, goodwill on this company if you think about it from an ability to sell. And this might also make management lazy, and therefore there's this natural cap on the multiple for such a company like this. So, and this is, as I just mentioned, this is also how it earns its money with the gas distribution, but also it's trying to really grow via targeted acquisitions. And we saw that last year in the USA with a minority stake, I must say, in the company there. And time will tell whether they will, of course, execute properly on it. And this is also one of the risks that I see for this company. So one really little thing I still wanted to show you in this report from 2019, because it's really interesting, because until 2020, their dividend policy was to grow their dividends with 5% annually. And they have been changing it a little bit now because also the regulatory environment is changing. So they've been also changing their dividend policy. And in 2019, they gave an update on that. And here you really can take it to your attention. So what stands out? Shareholder remuneration is one of our strategic priorities. In 2019, we increased our dividend with 5% again, as we pledged, and we are, of course, maintaining the dividend policy that we established until 2023. So you need to know that before it was still 2020, but they have now extended it to 23. So you can expect that the dividend is growing still to €1.74, while it's now around 1.62. And from 2024 to 2026, they pledged to not cut the dividend. So at least we have for 6-7 years, we have our dividend secured according to management. So if we then look more recently in their earnings reports, here I've got the Q3 2020 earnings, and you can see that there's a COVID-19 impact. So the income has been declining, also the EBIT, but the net profit has been growing. But this is because of one-offs, so we don't look too much at that. What is important is that COVID-19 has just some impact because, for instance, just think about, we are all working from home, so we're not going to the offices, so the offices don't need to have the full heating on and therefore consuming gas. There's just less traffic going on, less gas needed in cars. So this is one of the reasons why it went down. But in the last months, it started to pick up again. So it's not that bad as it looks like. It saw the dip, but it is expecting again that the earnings will be on 2018 level as by the end of the year, and potentially growing again next year. So if it now pays around 162 in dividends, that makes it a yield of 8.93. And what is interesting now to see here is if we go back to the price action from this month, you can see that it was trading around €20, 20.50, and then suddenly it had a steep decline. Well, the reason for that is that it got downgraded by Barclays and JP Morgan the other week. And with that, the shares fell almost 10% in total, I would say. And that really caught my attention because I started looking into Enagas after publishing my December watch list on my blog, and then one of the readers responded with that Enagas is also an interesting company to look into. So this is where I started to do my homework, and then when the price fell with 10%, I got really attracted to it. So let me share then with you a little bit what attracts me really into this company. So if we look into Enagas as a stock, it currently trades at €18.23. Now, what is important here is to first look at the dividend history for me, because I'm a dividend investor. And as you can see here, it has been growing their dividends since well, actually already for 19 years since it got listed on the stock exchange. It has been growing, and you can see early on in the last decade, at the beginning of 2010, it was growing quite rapidly, but then lately it has been growing the dividends for the last 5 years with approximately 5% per year according to the dividend policy. If we then look also at their funds from operations, which is a metric that I prefer to use for the utility industry, and thank you Eloy Snowball also for pointing me at it the other day. Their distributions and dividends is approximately 60% now, and it's been rising quite a lot over the last few years. Because if we look at their 5-year performance, you can see that the revenue has been slightly declining, and that their FFO per share has also been declining since 2018, or actually 2017. So this is something to take into consideration, that lately it has been declining, and this is not a good sign. But I do think that also with COVID-19, it's reaching kind of a bottom now, and I think this is also why the share price is reflecting it now, because the share price, I would say, really follows the cash flow, the funds from operations quite closely. You can also see that the share count grew a little bit, and this has to do with the acquisition from last year. So let's look into some of the metrics then that I really like as a dividend investor. So 19 years of dividend growth, a yield of almost 9%. Now, usually this is a signal that the company is in trouble, that the company would need to slash its dividend. But as you can see, I'm quite confident also with the management's promise to keep the dividend up to 174 until 2026. It's regulated. Their business is quite predictable, so not a lot can go wrong, I think, until then. However, it does signal really that there's something wrong in the company, because otherwise you are not at 9% in a bull market like this, almost, with such a safe business. I would expect the utility otherwise to be 5 to 6% in yield. So what is then the reason then? And I think it has to do with the decline in growth. You see it in the numbers at the bottom of this statistic. So the FFO has been declining. Also, the credit rating is now in the B level, while it had a higher credit rating a few years ago. And this is because also their debt has been growing with the major acquisitions they have been doing. Now, a reason for that, then again, what the impact is that also their return on invested capital is just really low, and it's just above their discount ratio. So what this means is that for every euro they are investing, they hardly earn a return higher than what it costs them to raise capital. So this is, for me, it's just a sign that the management is not really generating wealth to the business at the moment, and they have to turn this ship. If we then look at some of the valuation multiples here, so of the price to earnings of 10, 11, forward price to earnings also around 10.5, and a price to FFO of hardly 7. So for me, if I look to the price to FFO, this is just low. And this is something which shows that the company is under stress now. And the question is then, is the value trap? So for that, I've done a discounted cash flow calculation. And thanks, Van Carlin, because I'm using your template here. Thank you for sharing it. I use my own discounted cash flow calculator, but I like that there's more scenario analysis in this template. And I will put a link also to his template here. So I'm using the funds from operations of 690 million euro. And for the next 5 years, I'm assuming no growth. And after 5 to 10 years, I'm assuming 2% decline at discount rate of 5.2%, which I took from their annual report. And the terminal multiple as it is today of 7. I then subtract the long-term debt from it and add the cash from it. And you see that I have a per share value of 18.23. This is 4 cents below my purchase price, as you could see. Then I also have optimistic case that they get back to growth with 3%. This is more in line with what management is thinking. And then the 2% growth over the next 5 to 10 years and a terminal multiple of 8, because we would be more optimistic in this case. If this is the case, it would be 27 euro, their fair value. But hey, let's assume further declines. So we have a 2% decline over the next 5 years, 5% afterwards, and a really low terminal multiple of 5. Then the share price would be around 12 euros. So what we do then is we do a probability for that scenario. I think normal case has a 60% likelihood, and the other two cases 20% likelihood, and we get then to a fair value of 18.78 euro per share. So now that we know the fair value, I just showed you earlier in this video that I purchased 100 shares for 18.27. It is intended for me, according to my allocation strategy, to keep it a small position. So I have here like a position targeted for maximum 5,000 euro. With this position, I currently have already 75% of the dividends that I would like to have covered. So maybe next year in July, when they pay their dividend again, I might have another look at the company and maybe buy another 50 shares. But this is how I want to keep it. I want to keep it small. There's risk associated to this company. There's a 9% yield. But how I tend to do this, so if you look at the top of my foundational stocks, the top 10, it's a bit difficult here. Most of the companies spot a really low yield. And what it now allows me to do is, besides Enagas, for instance, I could now have a look at buying some Starbucks as an example. I find Starbucks currently really overvalued. So probably Starbucks would not be the first on my list, maybe even more DSM. But what I can do now is mix it up a little bit with a low yield company, which I really want as a core in my allocation strategy. So if I would, for instance, buy now DSM, let's say at 1.7%, I get on average with my buy also of Enagas, I get a 5% yield on the two acquisitions. So this is how I'm looking at it. So expect from me early in January another purchase from one of the top 10 companies to average it a little bit up, so that I keep focused on my average yield in the portfolio and mix a little bit growth with like a defensive as a utility. So this is it. This is why I bought Enagas, a nice high yield. The company has some issues. Let's see how it develops. But I think it's safe and it's protected by the regulators from Spain, and it allows me to mix up later with a lower yield company into my portfolio. So once again, if you find this content interesting, then visit me at europeandgi.com, subscribe to this channel, and if you want to get in touch with me, you can find me on Facebook, Instagram, and Twitter. I try to be active on all of them, and I'm quite engaged, so feel free to ask me any questions there and I will respond as soon as possible. Enjoy your weekend and the remainder of this year. Cheers!